Welcome to Good Money Guide, 50 rules that all traders should abide by. This isn't financial advice, this is just a collection I've gathered over the 20 years of being a broker and dealing with every sort of customer, from Mr. Jones trading with £500 spread betting to multi-million pound hedge funds taking percentage positions in companies. It's also some of the wisdom that we've gleaned from the CEOs that we've spoken to in our CEO interview series. So here we go. Good Money Guide, 50 rules that all traders should abide by. Run your wins. If a trade's going the right way, let it ride. Don't be eager to take profits too early. You can use a trailing stop to lock in profits as your position becomes more profitable. It's one of the most common mistakes that people make, is taking profits too early. Cut your losses. Fundamental to risk management. If you've got a trade wrong, close off the position before it gets worse. One of the worst things about trading is if you get too emotionally attached to a position and you just let those losses run away from you. Always remember, those who can trade, those who can't teach. With a few exceptions, the majority of trading educators are just snake oil salesmen trying to flog you a paid-for course on YouTube. Remember that successful traders will be trading. They very rarely want to tell you how they're making money. It's like gamblers. People like to keep their secrets close to their chests. You don't see hedge funds, for example, bragging about their trading strategies. Only ever trade with an FCA regulated broker. Don't muck about with unregulated offshore brokers, as you'll almost certainly get ripped off. It's really important that you trade with an FCA regulated broker and don't get tempted into going offshore because you get increased margins, because your funds won't be protected by the FSCS and you won't get the protection of the FCA. Always protect your downside. If your broker offers guaranteed stops, use them. Just think about the Euro Swiss peg when they removed that and everybody lost hundreds of thousands of pounds, in some case millions. If you use a guaranteed stop, even if the market gaps below, you'll still get filled at your price. Keep an open mind. There's opportunity everywhere. There's no need to just trade the top 10 traded assets. If you expand your universe of instruments that you look at, you'll find that there'll be relative highs, relative lows, and trading opportunities in markets you never thought existed. Never risk more than you can afford to lose. Trading's high risk and it's not for everyone. So unless you're hedging or an institutional trader, trading is for the fun money part of your portfolio. You should never risk more than, say, 5 to 10% of your overall portfolio in high risk, short-term speculative products. What's the easiest way to make a small fortune in trading? Well, it's an old joke, but is to start with a large one. You just have to look at any risk warning on any broker. You can see in the statistics that majority of traders lose money. So always make sure that you know what you're doing, and in particular, don't start too large. Don't Rio trade. And this is one of my favorite city phrases. A Rio trade is when you bet everything and more on a single trading idea. If it goes right, you make a fortune. If it goes wrong, you're on the first jet to Rio de Janeiro to hide out from your creditors and everyone else you've lost money for. Don't think you understand everything. You don't, because nobody does. If you read any book on investment strategy or even how to play poker, if you think you know everything, you're almost certain the person who doesn't. Don't cheat, and by don't cheat, I mean insider trading or trying to arbitrage something that you shouldn't. Everything is auditable and written down, and it will eventually catch up with you. There's no way to get away with cheating when trading, so stick to honest bets. Stick to what you know when trading. You can't be an expert at everything. I know we touched on expanding your universe of opportunities before, but you have to be aware of your limitations. There will be things that you don't understand. Just look at crypto, for example. Nobody really understands that, and so many people have lost money. Sure, a select few people have, but you would have to expect that they understand it a bit more than the people, or rather the majority, who have lost money trying to trade crypto. Always know when to stop. Trading is a learning curve. I've seen it so much over the last 20 years being a broker. People dive in with too much too quickly and take on too much risk. If you're going to start trading, always start slowly, manage your risk appropriately, and realize that also some people just don't have the mentality or indeed the money for trading high-risk products. Wear something red. This is really important. If you want to work in the city or be taken serious as a city trader, you have to wear something red. It could be socks, suspenders, a red bow tie, or you could go the whole hog and wear all 3 red, just like Justin Urquhart Stewart. Have at least 4 trading screens. No, you can't just trade from a beach with a laptop anywhere in the world. Screens are not just for show. It really helps with painstaking research, analysis, admin, visualizing the market through charts, multiple news feeds, and order execution. This is an important one. Don't post a picture of yourself driving a flash car on social media if you're a trader. You'll look like a scammer even if you're legit. You just have to look back on all the articles we've written on trading scams. Every single one of them almost certainly involves someone on social media trying to show off in some way, albeit with a flash car, a silly watch, or a load of cash, which is ridiculous really, because you certainly can't trade with cash. Always, if you're a trader, use a decent broker. Decent execution and experienced brokers and dealers can fix costly errors quickly. Errors are one of the most important parts of trading, albeit something you've done by mistake or something they've done by mistake. Having an experienced bank of dealers who can look after your account, in particular if you're a big trader, is worth its weight in gold and commission. When trading, always understand that your broker is not your friend. They may be friendly, but all they really want from you is commission. There are some brokers that run a B book, which means they profit when you lose, and there are other brokers which just charge you a commission and don't care about whether you win or lose. In fact, the brokers that charge you a commission actually want you to win, because the more you win, the more you'll trade and the more commission they'll charge you. Be on friendly terms with your broker when you're trading. Most brokers are just getting on, doing a job in the city because they love the markets and they love the industry. Just because brokers want your commission and your money doesn't mean it's a battle between you and them. Being on friendly terms with your broker is always worthwhile. Always when trading, buy your broker a beer or let your broker buy you a beer if the compliance department will let them. A libacious broker, always remember, is a loose-lipped broker, and the city is full of hilarious stories and anecdotes that a broker may let slip if you have just enough to drink. The early bird catches the worm in trading. It applies to most things in life, but really specifically to trading, the most important time of the day is the pre-market news, which is the information gathering stage. A huge amount of volume goes through first thing in the day, and that's when you can set up your trades. Sometimes, of course, there isn't going to be a trade there, but if you're not there for the open, you won't know that. Talk the talk when you're trading. This is all about understanding the lingo. Trading is full of phrases, both banter and technical, and knowing the broker's code and the trader's code will really help you out a lot. And just as with talk the talk, you must walk the walk when you're trading. Put your money where your mouth is. Trade in a live account to get an understanding of how well you're going to perform. Just because you've made money on a demo account, that's going to have no bearing at all when you start risking real money and taking on real positions. Don't talk your own book when you're trading. Nothing is as transparent or as dull as a trader bragging about their wins or trying to convince others they're right. You see it all the time on social media, on internet forums, people just talking up their own positions in the hope that other people will buy in and push that price up. Don't gamble when you're trading. If you just roll the dice on trades, the inevitable will happen. If you don't know what you're doing, you are going to lose money. Yes, there is a crossover between trading and gambling, particularly in financial spread betting, which is clearly structured as a bet, but don't just tap away and hope for the best. Do your research, plan your positions. Don't listen to the crowd too much when you're trading. One of the important things to remember is that if everybody's doing it, it's probably too late. In particular, if you're a smaller trader, you're probably the last one to find out, and all the buyers or sellers would have evaporated by the time you get into the market. Sometimes the trend is your friend. In direct contradiction to don't follow the crowd, sometimes it pays to ride the trend a little bit longer and go with the flow and run those positions a bit longer. When trading, feed the ducks when they're quacking. If people start clamoring for what you've got, you may well want to be rid of it before the bubble bursts. It's a great old city expression that's basically don't hang on to positions too long. If people want what you've got, let them have it. Buy when the cannon roars, one of Rothschild's old expressions. War isn't necessarily bad for the stock market. There are stocks that perform well during war times. Obviously, the market will take a knee-jerk dip, but overall, there are opportunities in the stock market when there is conflict. You don't necessarily have to be out of it. Don't be a prick for a tick. Now, this basically means don't try and hold on to a position in the hope that it will go up a tiny bit more. Taking profits a few ticks away from your limit is fine. And that basically means if you've got a limit in the market and you're not quite there, locking in a profit is fine, because if it doesn't quite hit your limit, it could come off and you're going to look like a right wally. Get size or get lost. This is the sort of thing that brokers usually mutter after they put the phone down to small clients. It basically means if you're a small trader, don't be a constant pain to your brokers asking them to work orders for you. Sure, if you've got a large order, if you're a high net worth individual or you're a hedge fund, it's fine to bother your brokers all day and be on the phone to them all day. But if you're a small trader, get size, get lost. Remember, he who finesses wears pink dresses. It's a bit old-fashioned now, as there's absolutely nothing wrong with wearing a pink dress, even if you're a man, but essentially it means just get on with it. Don't worry too much about trying to time the market on the way in. Beware the phrase choppy markets. Over 20 years of being a broker, this is what we always said if we didn't know what was going on. So if your broker says this during volatile markets, it basically means no one's got a clue what's going on. Don't trade if you can drive a bus through the spread. That basically means when you're trading and there is little liquidity in the markets, the bid-offer spread will be wide, which means there's little chance you can get in and out quickly because your buy and sell price will be so far apart. Look for a slightly more liquid stock to trade. If you pick bottoms, you'll get smelly fingers. And that basically means in trading, if you're constantly trying to time the bottom of the market, it's gonna backfire. If you're a buyer, just buy. Sometimes waiting for that stock to come down a little bit further before you buy isn't going to work out well. Don't try to catch a falling knife. It's a standard expression, but it works quite well in the stock market too. It basically means if the market's crashing, don't rush to buy into it. We see it all the time. People are always trying to pick the bottoms and wait for that dead cat bounce to make small short-term profits. But if a market's falling fast, sometimes the best thing is just to step away. The first cut is the cheapest. In trading, if you close losing positions as early as possible, in the long term, you're going to save yourself a fortune. Sure, it may turn out that you get some right, but overall, if your instinct's telling you to get out of a position, don't get emotional to it, just cut it. Buy the rumor, sell the fact. It's an old city expression in investing and trading. It basically means that price movements are almost always exaggerated and driven by sentiment. It's particularly relevant in a stock where there are bid rumors or acquisition rumors surrounding it. If there are, that's going to push the price up because people are speculating that it's going to go up. What usually happens, of course, is that nothing emerges or the bid price comes in below the market and the stock will come off. Don't be too long and wrong in trading and investing. This basically means when you've bought into a long position and you've quickly seen it drop, it means you're too emotional, too over-leveraged, or too committed to a long position. When you're trading, if you're on your phone to the broker and your broker says, mine, that basically means your broker, or who probably is a market maker, is really eager to get hold of the stock you've got. And it generally means you've sold something you shouldn't have. Worry if your broker says yours. This basically means you've bought something your broker doesn't want. If you're on the phone and you say, yeah, could you buy me X, Y, Z? And he goes, yours. That basically means he wants rid of a stock and he's perfectly happy to push it onto you. Worry if you're on the phone or you're in the trading room and you hear Phil. This basically means you've said something by accident that resulted in you having bought or sold something when you really didn't mean to. The old London Stock Exchange motto, of course, is my word is my bond. So if you are on the phone to your broker or a trader, you say something like that, they say filled, that means you're filled. Avoid markets that are thinner than a witch's tit. This basically means there's not much liquidity on the order book, so placing large orders will be problematic. Maybe look for a market that's slightly more liquid, or look at a better time of day to trade. Don't trade markets that are up and down more than a horse draws. This is an old city expression, probably not that appropriate for these days, but it basically means when the market's yo-yoing up and down and there are periods of short-term volatility in the market. Mind your eyes. This basically is a trader's expression for if you're a new trader, watch out for sharks wanting to take your eyes up by giving you a bad price. Don't be a sweet trolley. Again, more for the slightly older generation, but it's a phrase used when a novice trader places daft trade, giving the bigger boys treats and letting them mop up tasty stocks. Be careful buying if someone says there are more shorts than a Wham concert in this market. This basically means the market's on its way down. It could be that it's going to go down further, or it could mean there are buying opportunities because the market's oversold with short sellers and there may be a little bit of a dead cat bounce or a bear squeeze. Don't be short a bear squeeze. This basically means don't be short the market when it's forced back up. This means that short sellers are forced into buying their positions back either because the exchange or a broker has called back in those positions or because people are trying to bully them out of the market. Stops are for buses. Well, this isn't always the case because really stops are a fantastic risk management tool. They can help reduce the amount you lose on positions if you call the market wrong. But within the big boy professional trader circles, some people frown upon them. Remember, prices aren't door numbers. This basically means don't dilly-dally when executing a trade. If you want to go long, if you want to go short, just get on with it. Sometimes trying to pick that perfect entry point means you're going to miss your price and miss your position. Not investment advice. Thanks for watching our 50 rules that all traders need to abide by. If you've got any more, add them to the comments below.